Do you want the slow, steady climb of a marathon runner or the high-stakes thrill of a sprint finish? That's essentially the difference between investing in ETFs and trading ETF options on platforms like Wealthsimple. If you're using Wealthsimple Trade and trying to figure out which is right for your money, you're in the right place. Most beginners start with a classic ETF, but it's important to understand why options are fundamentally different before you take that next step. Let's break down the two. ETFs, ownership and diversification. An ETF, or exchange-traded fund, is a basket of investments, stocks, bonds, or other assets that trades on a stock exchange like a single stock. The investor's approach. When you buy a standard ETF on Wealthsimple, you are buying a fractional ownership stake in that entire basket. You own a piece of the fund's underlying assets. If you buy an S&P 500 ETF, you essentially own a tiny slice of the 500 largest U.S. companies. Your risk, it's relatively low to moderate. Your risk is spread out because you're diversified across many companies. You can lose money, but it's unlikely that all 500 companies will go to zero at the same time. Your strategy, this is a long-term, passive strategy. You buy it, hold it, and let compounding do the heavy lifting over many years. This is the marathon runner approach. ETF options, rights and leverage. ETF options are a different beast entirely. They are contracts that give you the right, but not the obligation, to buy or sell an ETF at a specific price, on or before a specific date. The trader's approach. When you buy or sell an option, you are not buying the ETF itself, you are buying a contract that speculates on the ETF's future price movement. You own a time-sensitive, leveraged contract. Options give you exposure to a large amount of the ETF for a relatively small upfront cost, which is called the premium. Your risk, it is extremely high. Options are complex, can expire worthless, and you can lose 100% of your premium very quickly. This is the sprint finish, a high-risk, high-reward bet. Your strategy, this is a short-term, active trading strategy. You're betting on the direction and timing of the ETF's price movement. This is for advanced traders who understand concepts like implied volatility and time decay. Here's the takeaway for beginners: if you're building a retirement fund, stick to buying and holding ETFs. They are proven, diversified, and align with a long-time horizon. If you are an experienced trader looking to use leverage or hedge positions with money you are comfortable losing entirely, then exploring ETF options might be for you. Just remember, the tools are different, and so are the risks. With that said, thanks for watching, and until next time.